Today we are going to explore the many ways a reverse mortgage can benefit older adults. Are you ready to reverse your thinking about reverse mortgages? Let's jump in. Trust deeds and mortgages are both used to create liens on real estate in bank and private loans, and both are generally recorded as debt in the county of the property location. While there is no legal method to prevent additional liens from being put on the house, the reverse mortgage retains the first lien status for the duration of the loan in many situations. Selling the house will pay off the reverse mortgage debt before the proceeds are distributed to others. Because the debt on a reverse mortgage loan increases over time, the lien is generally put on the property for 150% of the house value rather than 100% of the original loan amount. As a result, new creditors may have a limited likelihood of receiving a return on a lien they may place. This information is beneficial for high net worth individuals. Personal injury lawsuits, whether genuine or fictitious, have minimal likelihood of success as well. It is not financially feasible for them to invest time and money in obtaining lien status only to get nothing when the house is sold. When a creditor discovers a reverse lien on a debtor's property, the creditor usually writes off the debt as non-collectible. Suppose a creditor or personal injury attorney decides to proceed with the lien procedure. In that case, he or she cannot garnish the reverse mortgage proceeds, regardless of how the homeowner chooses the payout. This detail provides an income for the homeowner, protection for the reverse mortgage lender, and no recourse for the creditor. Reverse mortgages, which at one point were expensive and viewed as the Wild West of loans, have come a long way in recent years, thanks to increased regulation and consumer scrutiny. Whereas in the past, such loans were only beneficial as an option of last resort, today, they can be valuable tools in various situations. They can aid in making sure clients meet their retirement goals. Reverse loans are available in a variety of forms. Line of credit, which increases over time. Term payments, similar to a period certain annuity. Tenure payments, which are similar to a life annuity. Lump sums. A combination loan consisting of two or more of the above options, and as a purchase loan for a new home purchase. Of all of the above options, the line of credit reverse mortgage could be the most valuable in terms of planning opportunities today. Retirees are using such loans to a significant effect in a variety of ways. For instance, in the event of a substantial market correction that leads to a significant decrease of portfolio assets, using a reverse mortgage line of credit can help clients meet their income needs while avoiding tapping their portfolio at an inopportune time in the market cycle. Such loans can also help meet significant expenses, such as long-term care costs if a client does not have adequate coverage otherwise. Whereas in the past reverse mortgages were only beneficial as a last resort, today, they can be valuable tools in various situations and aid in ensuring clients meet their retirement goals. A reverse mortgage is an opportunity to incorporate a dormant asset class or home equity into the financial planning process from a retirement planning point of view. It works explicitly for mass affluent clients with a net worth of anywhere between $500,000 to $9 or $10 million. For a lot of them, home equity does represent a large portion of their net worth. So when looking to plan a 30-year retirement for your clients, it does not make sense to leave this portion of their net worth of home equity out of that planning process. Using the reverse mortgage gives you access to capital again with no required principal or interest payments. And you can bring that capital into that planning process for whatever you need to do, whatever you need for it to do. This is ideally suited for the majority of baby boomers age 58 or older. You must be at least 58 to qualify for one of these loans. And it is beneficial to discuss home equity as they are rolling into their 60s. So, let's have this conversation. Once you hit your 60s, it's kind of like the light goes on, and you are stuck with the fact that you are in your last decade of working. You need to start planning how you're going to fund the next 30 years or so of your life because you are pretty sure that your mind and your body isn't going to be working perfectly till 90. This is a great time to have that conversation about home equity. So doesn't it make sense to bring it into the planning process in one's late 50s or early 60s? Most mass affluent baby boomers have the lion's share of their wealth tied up in their homes. So the sooner home equity is brought into the conversation, the greater the chance of not running out of money in retirement. Allow us to reverse your thinking about reverse mortgages.